We are joined by John Herrman from State Street Global. It's great to have you on the show.
It's really wonderful to
All
be
the
here.
way from Boston.
I know, all the way from Boston back to New York.
Yes, it's always wonderful. Now, we see that the street, Wall Street, takes European cue, especially with the successful Italian bond. The auction went very well. And was it a surprise? And what is next?
I think it was a surprise, and it just suggests that when we get into next year, first half of next year, many of us had been concerned that with all the debt that's rolling over and it had to be refinanced, we were worried that whether or not there would be a strong private demand for that debt, given all the uncertainties in various countries. And today's auction results, bid to cover ratios and so on, are pretty decent, and it just suggests that maybe we can get through the first 6 months of this year without any hiccups, which would be great, and that would just help the markets actually improve from where they are right now.
So you see a hope and light at the end of the tunnel for the European sovereign debt crisis in a
I'd say I see hope. Light at the end of the tunnel is, they have a big problem there because we're looking at about $1.5 trillion, trillion and a half dollars or euros in terms of debt that's maybe need to be restructured, and that's the size of that is a little bit smaller than the U.S. mortgage debt problem, but it's still, we've taken us 3.5 years to work our way through the mortgage problem, and we still have another 3 years to sort of go. So I think what it means is that there's some hope, but Europe has to just stay at it, just the same way the U.S. has to. Each month, each year, we have to just persistently work our way through this problem, and Europe's going to have to do the same thing as well.
I'm glad you brought it to the U.S. because you've been chosen Bloomberg best economist throughout whole 2011. You've been the best forecasters in terms of GDP and all other economic data. Talking about the growth, where do you see growth? Where do you want to see, or where do the investors want to see growth to be in 2012?
I think so. Let's just see what we see. First,
Yes.
we see growth is last year in 2011 we sort of struggled to grow at just below 2%. And I think that the first few months of the year we're going to get better job growth than people are expecting, and I think in general we're going to continue though to grow around this 2% mark. And we do have some concerns about 2013, and the one big concern, just to simplify things, the one big concern is that we have about roughly somewhere between $400 and $500 billion of fiscal stimulus that will expire. And that becomes a question of what do we do? Is the economy strong enough to allow it to expire, or do we have to roll it over again in another form of stimulus? And that's just tremendous amounts of stimulus, and then it becomes like a question about the debt. So I think for 2012 we do have okay growth, 2%. We have some concerns about 2013. Markets will be aware of that. Investors will be aware of that. But I think in terms of what investors are looking for is this.
Yes.
They're going to say, okay, look, we want, they have concerns about Europe. And I think even though professional forecasters are saying Europe is going to grow like maybe 0.5%, I think investors are thinking, okay, it's going to contract and maybe contract 0.5%, maybe 1%. That's what investors are thinking. So I think if you get something like that, it'll fit with what investors' expectations are, and I don't think that will be too worrisome. I think if we can see better growth in the emerging markets, and if for some reason we can see the U.S. outperform, I think that would be huge, because then investors would say, the U.S. and the emerging markets are able to propel themselves even though Eurozone is going to go through their adjustments. And I think that's really important, because they'll know that within another year or so, past this, the Eurozone should begin to gain some traction. So if the U.S. and the emerging markets can continue to grow and continue to recover, I think that will really help investors. And there's a little bit of reason to be optimistic here. And the reason why is this. Many of the countries in the emerging markets are now easing monetary policy, as opposed to the last 2 years where they were tightening policy. So their economies are slowing a little bit, but at least policy now is going to stimulate their growth. And that, in conjunction with all the things that America's doing for this year, and monetary policy continues to do extraordinary things here in the U.S., it offers up hope that we can get things going. And that's what investors should try to take advantage of in the early part of this year, which would mean, 2012, that would mean the first few months of the year, stock markets should go higher.
Talking about stock markets, now, do you tell your clients, your investors, to move away from the safety bonds into the equities, or do you offer alternatives?
Well, we've, you know, for the last 2 years, this can sound horrible, for the last 2 years we've been a proponent of the safety because we've had so many concerns. So what we're now suggesting to people is, you know, with the yield on the Treasury so low,
Right.
we're suggesting, and we basically hit the numbers we were looking for. Actually, our numbers were even a little bit lower than the yield of 2%. We were thinking it was going to go to 1.6%, something crazy like that. But we got to, one point we got to 1.7, so we're close to the target. So I think the thing is, investors have to say to themselves, all right, look, they had a lot of concerns and anxiety that drove these yields to these levels. At this point, investors have to ask themselves, on a risk-adjusted basis, just risk, simple, you know, simple finance 101, risk-adjusted basis, do you want to own a Treasury yield at 2% when inflation is over 2%, or do you want to own high-grade corporate credit that's 3.5%, 4.5% yielding, or do you want to own equity-yielding stocks that are also higher, you know, dividend-paying stocks, high-quality dividend-paying stocks, IBM, that kind of thing? That the dividend yield is far greater and covering, on a risk adjustment, covers you for inflation, covers you for default risk. These companies have extraordinary cash on the balance sheet, so from a standpoint of credit quality, it's a very high quality stocks, and the debt is, you know, has a good backstop in terms of the cash, the cash retained earnings, cash reserves as well. So I think that's where investors really should start moving to. And here's something else. On a pure sovereign basis, you know, you could, as an investor, you could invest in Australian debt, you can invest in Mexican debt, you can invest in Brazilian debt at far higher yields than what you're compensated here in the United States. And those countries have demonstrated, you know, good discipline in terms of fiscal policy. They've demonstrated good discipline in terms of monetary policy. And these, again, on a pure risk-adjusted basis, I think these are some neglected areas of the fixed income universe, and I think they could find yield there. And then one last place, and this sounds really pretty crazy, in terms of the U.S. mortgage market.
Yes.
The mortgages out there, the mortgages that are able to get refinanced now are very high-quality household mortgages because it is so tough to get a mortgage now. The mortgage refinancings, the average FICO scores are over 770. So that means you're looking at, I just refinanced, my FICO score is 840. I hate to say it on TV, but it's 848, 850. So you're talking about very high grade household mortgage loans. So they're scarce. There's not that many of them. But I think that's also another area where people
Are you saying that
I know,
they should be
so you're looking
investing in
in mortgage debt. I mean, can you believe I'm saying that?
They shouldn't be scared?
I think they shouldn't be scared. I think you're looking at basically the top tier of U.S. household
That's very
borrowers.
interesting.
And they're very, very high grade. And the Fed, you know, the Fed competes with you in this market because the Fed really likes to own, of the mortgage debt
That's
that
right.
the Fed owns on their balance sheet, they want to own the top tier. That's what they want to
Very
own.
interesting take on that. And going back to the emerging markets, John, is Turkey among one of the emerging markets to invest in, by the way?
I think so. So I think, you know,
How do you see Turkey?
I just, you know, I think you have to look at, in terms of the growth prospects, the resilience of growth. You have to look at, you know, the discipline. A lot of the countries share these characteristics in emerging markets. You know, their ability to grow amongst themselves, their linkages with other emerging markets. And then in addition, just their discipline in terms of debt to GDP ratios. In many cases, they outperform the developed market in terms of, you know, what we thought of as being, you know, high grade, investment grade, sovereign debt. You know, whether we were talking about Spain, you know, if you went back 5 years ago, 6 years ago, and said, gee, you know, Italy, Spain may not be investment grade sovereign debt, that would have been heresy. But you know, now it's a little bit, you know, those concerns are a little more commonplace. So. I think, you know, we have to just really look at, and even in the developed market, I think you can also look at, for example, Swedish debt and some Norwegian debt, things like. There are some very, very high grade debt within the developed market and in the emerging markets. But you know, investors buying treasuries. I'm a treasury guy, so.
But you're talking about the equity.
But I'm
That was
talking
very
in general. But I'm
interesting.
talking in general. You know, I know that on a risk-adjusted basis,
Yes.
equities are not. Sorry, the U.S. Treasuries are really not compensating you for the risk.
How about 2012? I hear you're bullish in the stock market, but we had a very flat year. We had a volatility elevated all throughout the year. S&P 500 within the last 41 years had the least gain. So where are we going to see S&P? And this is my last question.
Okay, last question.
So
Here's what we, so when we look out. Last year was a very difficult year, as you know.
Yes,
I mean, we had the Fed. I mean, the Fed did QE2, finished QE2. That turned out not to be enough. We had to do Operation Twist. We had to do. I think QE3, you know, cannot write it off. I think it's possible, but it's second half of 2012 at the earliest.
Second half
at the earliest,
okay,
if it happens. So, you know, we did QE2 here, and that turned out not to be enough. We did Operation Twist here. You know, I don't think that's going to be enough. We are doing a host of other things in terms of fiscal policy here in the U.S. We had lots of uncertainty in the Eurozone. I mean, there was something on the order of 19 summits in the Eurozone area.
That's true.
Just in the last 12 months, just to try 19, that's, you know, more than one a month, just to try to get the process and move the process along. Very difficult challenges in Europe. Very, very difficult. So I think, you know, when we look out to 2012, you have to say to yourselves, in the emerging markets, they were down on the order of 15 to 20% in emerging markets. Stock performance in Eurozone down also 15 to 20%. The Dow was flat year over year, so that's pretty amazing. So I think, you know, the question becomes, do investors move out of the safety? I don't think they're going to abandon the safety completely. I have to be frank with you. I think our indications of investor behavior is that investors are still long-term investors are still very cautious. So I think what they're going to do is still hold on to a lot of these very high quality stocks in the U.S. and in Europe, and hold on to those, and as well as to hold on to a good chunk of Treasury debt because it's so liquid and it's safe. You know you're going to get your principal back. I think they're going to hold on to that. But I think what they're going to do is, on the margin, they're going to start moving, you know, some of their funds out and into, you know, again, emerging market debt, emerging market equities. I think they could move it into some companies some high-grade companies in the Eurozone. Excuse me. And so the Eurozone stocks could potentially benefit as well. So I think that's the issue. And just to tie it up in the beginning, if we see more and more and better progress in terms of the auctions that go on in Europe in the next 6 months, if we can continue to surprise to the upside, like we saw today, good demand for the debt and the yields falling, if we can continue to see that, I think in general people will be pretty amazed, and I think investors
to see Dow Jones at level,
you know, and level, and I think investors will begin to take the step. They'll go back out into the waters. We'll say.
Sounds very good.
We have to hope.
Thank you. I hope so too.
We have to hope.
Thank you for joining us.
Thank you so much, Melissa. It was a pleasure to be with you.
The same here.